So how do you explain the current round of market volatility? Is it just normal market volatility that we haven't seen in some time, or what?
Look, within a longer secular cycle, you can have these periods of softness. I think the market's concerned really about two things. They're concerned about the removal of monetary and fiscal stimulus and whether or not that means that we're in for an interim peak. Our view is that while the Fed is going to continue to raise rates, that next year is going to be more like 2 rate hikes, not 3 or 4, and that pause is going to be softer than the market's expectations for the Fed to continue to raise rates from now to the end of time. And then also, we think on the fiscal policy side, there's some concern ahead of the midterms. We don't think the midterms are going to yield a market unfriendly outcome.
So that's a pretty good picture, and it sounds persuasive. What don't the CEOs see? Because what we're seeing right now in earnings is not so much that they're missing on earnings, on revenue or earnings per share, but the forward guidance. They do not see into 2019 right now and see it very rosy overall with the earnings. What's the C-suite missing?
So I think there's a couple things going on. Let's remember that earnings are growing at 26% in Q3 so far. That is as good as it did in the first half.
But that's to my point a little bit. They're growing robustly, and yet the market is saying no thank you very much because of the forward guidance. Because
we're concerned that fiscal and monetary stimulus are going away and that we've hit a peak in earnings. Now, we've been through these periods throughout this bull market run, right? In 2015 to 16, you saw a similar period where you had an interim downturn in earnings growth. But for the long-term investor, if we have a pickup in productivity, if companies are continuing to get more efficient, you should use these opportunities to add to your long-term position in equities.
What specifically?
So right now, it's hard not to like a lot in the U.S. I mean, I think you can look at this a number of different ways. If you're more bullishly inclined, you can look at value cyclicals, which have gotten hammered.
Right.
Energy, financials, materials, industrials. I think the dividend part of the market is also cheap now because, again, it's pricing in rate hikes between now and the end of days. And if that doesn't occur, you should get some relief. And then finally, small caps, which benefit from a lot of things that are going on in the United States, particularly this move from big companies to small businesses that we think is engendered by this industrial revolution. So the U.S. is on sale, and we added to equities at Federated a couple weeks ago. And
you did?
Absolutely.